Alright guys, welcome to the last video in our day trading lesson. This video will go over the two pillars that are key to be successful in trading, that is trading psychology and risk management. In the previous videos I talked about technical analysis, talked about brokers and submitting orders, and these things can be easily memorized and trained. But when it comes to trading psychology and risk management, these tools come from experience. It comes from experiencing losers, experiencing winners. It comes from experiencing winning trades go against you, from having red days and having green days. And it comes from the experiences that you will then build upon your trading psychology and your risk management. Day trading deals with a fast-paced environment where you're in and out of positions within minutes and sometimes seconds, where the gains or losses can be very substantial, right? And in such a fast-paced environment, so much so that so much majority of people see day trading as another form of gambling. So it can have a toll on your emotions, and sometimes your emotions is what can lead you to make errors and blow your account. So in this video, I'll be going over some common mistakes that traders make when it comes to dealing with these emotions, as also ways to combat these to help protect your account. However, your trading experience is unique to you, and some might pick this up quickly, and some for others it might take some time. For me, like I said previously in these videos, it took me about 2 years for me to master emotions and become consistently profitable trading. As always guys, just want to give a quick disclaimer that everything I talk about in this video, plus all the material provided on Discord and in the trading room, is for educational purposes only. Nothing should be considered financial advice. Also, make sure you guys are aware of the risks when it comes to trading in financial markets, especially when it comes to trading highly volatile and leveraged assets like futures and options. With trading, you have the ability to earn high returns, but there is also a high level of risk, and you can blow your account. So please make sure you guys are aware of that, and please do your own due diligence. Everyone's trading journey is unique to you. There will be certain emotions that you will have to deal with and master if you want to be successful at day trading. However, the three are the most common mistakes that new traders make. The first is FOMO, the fear of missing out. The fear of missing out can cause new traders to constantly be glued to charts so they don't miss a move in markets, which can lead them to being impatient and entering trades based on impulses. FOMO can also cause someone to jump in early on a trade without waiting for the strategy, but anticipating the move in the fear of not getting in at a better price. Fear and greed are probably the two dominant emotions when it comes to trading, and probably the most troublesome to get over in order to become successful. The next most common mistake is over trading. In a previous video, I talked about the different modes of the market can be in. During mode 1, chop markets, markets move sideways, and it can lead to false breakouts and quick reversals. This can cause new traders to fall in the trap of over trading. Also, the charts that we display on the algo for you guys is on the 1 minute chart. And as you can see, price in the 1 minute moves up and down a lot more than any other time frame. And this can cause new traders to quickly start scalping positions, try to catch 1 minute moves for small gains, right? This usually leads to a lot of new traders catching small winners and having bigger losers, which can ultimately destroy their account. So in order to combat overtrading, it is helpful to zoom out and look at the higher time frame support and resistance levels. Another very common mistake that new traders make is revenge trading. Revenge trading is when they see red in their account, and it can lead them to saying mentally, oh, I can't make that back. This leads to impulsive trading and can even lead to them magnifying their losses. To battle revenge trading, you have to be okay with taking red days and accept that not every day is going to be green. But if you can constantly have more winners than losers, then overall your portfolio will be good to go. You can also combat revenge trading by limiting your number of losing trades per day. For me personally, I have a rule where if I have two red trades in a day, then I will stop trading, step away from the screen, and come back refreshed the next day. Alright, so when you think of the ideal trader, essentially the ideal trader is someone who is disciplined. To be successful in day trading, one must be able to master their own psychological responses to markets rather than try to predict the market. Again, the market doesn't owe anyone anything, and the market doesn't care about me, doesn't care about you, and doesn't care about anyone who participates in it, and it does what it will do, right? So knowing that, you have to be successful in mastering your own personal emotions that it comes to when entering and exiting positions, since the market doesn't really care, right? So again, the ideal trader is disciplined. But what does it mean to be disciplined? Does that mean you have to wake up early every morning, exercise, eat healthy, stick to a strict diet? Well, in trading, it just simply means that you have the patience to wait for your strategy. When you wait for the strategy, that means that you're waiting for the sub to come to you, and you're not out hunting looking for any quick fix. Being disciplined is also meaning that you setting realistic expectations. You expect that most people once they start trading that they'll be making thousands of dollars right away. And it's easy to think that way because that's what gets fantasized in movies and all over financial Twitter. But in reality, it doesn't work that way. It takes people years to scale up in order to achieve those types of gains, and they are possible, but the chances of getting that day one is highly unlikely. So it is important to set realistic expectations. Even a simple $200 a day is $1K a week. And those small gains can then add up and allowing you to scale up in the future as well. So the goal is we don't have to hit home runs every day. Consistency is what's key. At the start of this video, I had mentioned that your trading journey is unique to you, and there will be certain things that you will have to self-discover. The way you do this is by journalizing your trades. If you journal your trades, it can help you identify common errors and success points in your trading journey. It will help you assess what is going wrong, and you can actually learn from it. It is important that you don't just journal your trades, but you actually go back and review your trading journal to identify trends in your trading. When journalizing your trade, it's important to take a picture of your trade, to put in your entry and your exit price, as well as your profits and your reason for entering and exiting. Alright, so the last part of this program, I will be going over a very important pillar to be a successful trader, and that is risk management. Risk management includes using strategies to help reduce your potential losses. Right? So when you first sit down with an investment advisor, they usually ask you a bunch of questions in order to gauge your risk tolerance. They review your cash inflows and your cash outflows to determine your risk ability, and then they ask you characterized questions to then determine your appetite for risk. This is something that you will discover for yourself if you decide not to go through a financial advisor. When determining your risk tolerance, especially with trading highly volatile assets like options and futures, you have to be willing to take high levels of risk since you do have the potential of losing your capital. To review the risk of trading options and futures, please review the disclosure in the disclaimer channel of our Discord. So, two most common risk management tools that are used. The first is position sizing. When purchasing contracts, you can choose how many contracts or how much stock to purchase. The more you purchase, the more it will magnify your gains and your losses. So the more size you play, the higher level of risk you are willing to take. So it's important to be able to discern areas of high risk so that you can size down in the case of reversal. Sometimes in my morning updates, I will mention that I'm sizing down my position due to choppy market conditions that are present primarily after big run-ups or big data days. The next key risk management tool is having a stop loss. So it is very important to consider a stop loss when determining proper risk management. Setting your stop loss is setting how much you're willing to lose on a trade, and should always be included in any type of strategy. Without having a clear defined stop loss before even entering the trade, it could lead to emotional biases during the trade as well. At the end of the day, having a stop loss is what can really protect your account and is absolutely key. And if you guys can review our stop loss strategy in video 5 of this lesson. I only trade one asset, and that is S&P 500 futures. I've only traded S&P 500 futures because I've studied its price action for so long, and it provides me with a consistent return, so why would I trade anything else? When trading ES, some examples of risk management strategies that I use is that I normally pay 3 to 5 contracts per trade, and if I size down, then I'll pay 1 to 2 contracts. I limit my max stop loss to 5 points, which is 20 ticks per trade, and I limit myself to only 2 losses per trade, so as soon as I hit my second loss, I will step away from my PC. Alright guys, if you are brand new to the world of investing, I would recommend that you go over these concepts again and even do some independent research online until you completely understand the workings of the financial markets. Once you do, the next step will be to backtest your trading strategy and paper trade until you are comfortable trading with real funds. And once you start with real funds, start slow and then begin to scale up. As always, we do provide live commentary on markets from Monday to Friday, 6 a.m. to 4 p.m. in the private chat room, and we're always open to questions during this time. Alright, well, that includes this little video series. I hope you guys found these introductory videos very helpful to kickstart your trading journey, and welcome to the Algo Snipe trading team.